All right, welcome back to the third session of the 2026 DoubleLine Roundtable Prime. And we're approaching our third segment here where we're going to talk a little bit more about the markets, but I want to segue that into the ways of thinking about positioning portfolios. And during the break, I was asked from one of the members of the audience, thinking about the equity trade to the mid, small, international, and how people are thinking about that as well. So I'd like you to incorporate that into your comments. We'll start with you, Danielle, down there, but I wanted to show everybody what I brought as my best idea for the year, and this is for the camera. I love bonds. You might be shocked by that, but this is where I'm coming with our best idea. I think the bond market's a great place to be this year, and that's why I'm sitting next to Rosie right now. So anyway, with that, now I'm trying to make amends for all the things I said ill about you today, David. But Danielle,
just to my face.
Okay. Oh, yeah. The other stuff was under the breath, right? But Danielle, let's start with you too. Where you see things going. If you have a view on those different segmentations of equities, and kind of how you're thinking about it as the playbook for this year, understanding that we're mired in uncertainty, not just from policies, but just the impacts, the data, and the like. So
we were very much outside the consensus last year, anticipating 4 rate cuts for the year. We only got 3. At QI, we think we're going to get 4 rate cuts in the first half of the year. We see the unemployment rate specifically hitting 5% before mid-year. So by the June unemployment rate, we see the payrolls report, we see the unemployment rate around 5%, and then continuing up higher as the year goes. The unemployment rate moves like any other market. It tends to gain momentum on the way up. With that in mind, we've kind of got the year separated out into first halves and second halves. We think the belly, we think the 5 outperforms in the first half of the year, and then there's going to be this semblance of capitulation, and then you fall into the 2s towards the second half of the year. We think the dollar is going to be weaker in the first half of the year, and then if things are as bad in the United States as what we anticipate they will be, I don't think you'll have as much hawkishness out of the Christine Lagardes of the world. We're seeing inflation prints come in lower than expected right now in Europe. If the United States catches a cold, I'm sorry, but the rest of the world's still going to get the flu. So, but we see the dollar then strengthening into the second half of the year.
So you took the page out of Charles's book, The War and Peace. It's a tale of two markets.
It kind of is. We see commodities as having a strong first half as well, and then tailing off. But we are very, very bullish on.
Is that broad-based, or do you have specific?
Broad. Yeah. But when it comes to specifics, we're very bullish gold and silver miners throughout the year. Okay. And it's just because of how they behave when uncertainty rises as much as it's rising. And uncertainty right now, because the private credit space has become so enormous, and because non-depository financial institution lending has grown by 92%, and that basically is conventional bank lending to the shadows, to the privates. And I don't think a lot of people have a good appreciation for the very tight direct conduit between the conventional banking system and the shadow banking system, the non-banking system, the private equities, the private credits of the world. There's a real tight linkage there. And actually, Rosie wrote about it several months ago, but we're following the phenomena of these weird days when the Dow is really outperforming the NASDAQ. And so I think if I was to put a punctuation point on it, we look favorably at the Dow. In other words, if we were going to put a trade on one way and the other way, we'd be favoring utilities. And in a falling interest rate environment, and given conventional banks' exposure to private equity, private lending, we'd be unfavorable on the financials. So that's kind of where we sit.
On that front, I got to guess that means you don't like small cap in that scenario.
I mean, tell me the percentage of small cap companies that are making money. What is it, 30% maybe? I mean, the sheer percentage of small caps that are profit losing, cash losing operations is just stunning. Yeah. So I mean, rotations are rotations, and movements are movements. But you stole my T-shirt.
Mm-hmm. What?
I'm kidding.
I'll get you one. I know where they make them. Yeah. On that, thank you for your views there, Charles. I know you get you want to give us some sexier ideas, kind of down in the single name area.
I'm a sexy man. Yeah.
You're sitting by Rosie. I'm sitting by him.
Yeah.
So I will say
it's coordinated the outfits too. The color scheme is pretty close.
That's what we do. That's what we do. So I will though start with the small cap thing because it's a great point about like the Russell and whatever the number is, 48%, either profitable or unprofitable. I forgot what the number is, but that's another reason the S&P 600 is outperforming significantly the Russell 2000. But within the small cap area, there's some names, some technology names that Credo, CRDO, that's a name I think could be up this year, 100% minimum. But yeah, sexy. I'm just gonna tell you, I made more money for people last year than I ever have in my life. Now, my number one stock was a company called Rocket Labs. In my own account, I bought it for $650. I sold it at $54, mostly because I was going through a divorce. Right now, it's $80. I made people 1,200, 1,300%. And by the way, I mentioned this not just on my show, not just to my subscribers. Everywhere I went, my agent is a liberal Democrat. So when the market was falling apart on reciprocal tariffs, like, Trump's killing us. I said, shut up and buy Rocket Labs. Of course, I busted chops every time because he didn't buy it. Space is going to be a huge, huge driver. I look at the markets and I look at this as the fourth industrial revolution. And I go back and I look at the other industrial revolutions, particularly the second one. And you go from 1850 to early 1900s and peaking, you could even say the Chicago World's Fair, which introduced American-style consumerism, when capitalism delivered disposable income. So we could buy chewing gum, we could take a Ferris wheel, and all of the inventions along that way. Now, the problem was, though, during that time period, if you look at the stocks that traded, only rich people had access to the market, right? I think it was like 1910, the top stocks in the New York Stock Exchange maybe had 1,000 shareholders.
Bid offer was like 10%, right? Wait.
And this is the time I'm telling folks, this is the time you could be the robber baron of this particular industrial revolution. So one of my big names, it's a small company, but a name I think will do well. Full disclosure, my subscribers already own O&DS. It's up 84%, but I'm looking for that to go up 200 or 300% this year. It's a drone play. It's modern war. We saw what happened with Ukraine, Russia. There's just you have to have exposure to unmanned aerial vehicles. That is just the way war is going to be fought. I would say a Palantir, but it's already up a lot. If you look on when they took out Maduro, what stocks went up the biggest that day? Chevron, because they were the only oil company that didn't leave, but Palantir hasn't stopped going up. Even when President Trump said to the defense contractors, hey, listen, I'm going to start cutting, you have to build more plants. You can't have a free ride anymore, because we have had a major shift in the way we're going to fight wars, in the way we're going to defend our country, and there's no bigger use of taxpayer money than on defense. That's going to be huge. Hopefully, it'll get back above interest rates and the interest we're paying on our debt.
Do you see the news today about us to take it to 1.5 trillion, the defense budget?
Yeah, and a lot of
I don't know where the money's supposed to come from,
but a lot of it's going to go to these. Yeah, you know where it's coming from. Did you write the check yet? So
the chump.
I like copper a lot. I think copper is the commodity that you want to be in. I think copper is going to do extraordinary. It's already making. Yeah, it's already got some great runway here. Utilities are listen, they're doing pretty good, but I think I'd rather get involved in the names that build utilities or build plants, right? The Qantas is a PWR, Qantas is of the world. And my sleeper pick for the year is First Solar. And ironically, the solar stocks did extraordinarily well under the first Trump administration. And I just think that our need for power, I mean, the power crisis in this country is just phenomenal. We need power. And I hate to see these cities that turn down these data centers. I really do. Like these small towns where we're worried about this. You're going to be a tumbleweed's going to be in your town. Take these data centers. All this other things are going to be figured out along the way. So I say ride the Industrial Revolution. It's stay the course. It still has a few years to go. And if people really, really invest in it. And again, every time you hear about AI, they should talk about the Mag 7. It's so much more. Last year, Caterpillar was the number one stock on the Dow Jones Industrial Average because it's now considered an AI play. So now the companies that use AI, that are implementing AI, are the names that are going to do extraordinarily well this year.
All right, that's great. Jeffrey, you're next.
Yeah, I think the electricity thing is really something. We've been following charts about how electricity bills are going through the roof in the 5 states that have the most data centers. And it's interesting that it's really residential electricity prices that are really going up. The industrial electricity prices have been increasing less. And in fact, in nationwide, industrial electricity prices are unchanged since ChatGPT showed up. Whereas in the 5 states, that have the 5 states for the data centers, there's a substantial increase. So there's a kind of a war brewing. You mentioned the towns that don't want data centers is because they don't want their electricity to go up.
Right.
Electricity is a funny thing when you talk about cycles and booms and societally changing things. One of the things that changed the world more than anything else was electricity. And electricity really got going around 1900. And by 1911, almost nobody had electricity. You had to be super rich to have electricity by 1911. But the relative performance of electricity stocks versus the rest of the U.S. stock market peaked in 1911. So one of the things that happens is with all these, very transformational technologies, people see it pretty quick, and you get the gain very much at the beginning.
Well, there's 2 phases that I've seen: the hype phase.
Yep.
And then when you can't deliver on the hype phase, it sort of fades away.
Yeah.
And I always talk about the NVIDIA.
When they don't buy their chips anymore, they're going to be discounting them pretty.
Well, or they assume things are going to happen, but they don't happen immediately, right? So like 2025 was supposed to be the year of the robots. No one's seeing any robots around. And a lot of these robot stocks went up and they peaked. Or like the energy thing, some of these small nuclear reactors, SMR is a stock symbol, for instance, exploded.
Yeah.
Now it's come all the way down. They can't live up to the hype, but I always tell people, keep it on your radar, because when they start to live up to the hype and no one's buying those stocks, they become great buys, down the road.
My sort of framework for portfolio construction is almost exactly the same as was a year ago. And maybe that's kind of a rookie mistake that I'm saying with it. But it certainly worked very, very well. And it was built around the pillars of the ideas being that the dollar is going to go down and that long-term interest rates will not fall when the Fed cuts interest rates. So I basically believe that investors should have about 30% in stocks, but I think it should be non-U.S. stocks owned in foreign currencies, because I think the dollar is going down. And it's interesting that the dollar has been going down, even though our interest rates are higher than some of the others that we compare it to. Their currencies are rallying, even though the interest rate differential has been increasing. So I think one should invest in non-U.S. stocks. European stocks for dollar-based investors greatly outperformed the S&P last year. Emerging market stocks did well. I think that's going to continue. I think investors should have something, depending upon what a risk tolerance you have. I think you should have 15 to 20% in real assets, be it a broad commodity index, be it gold, be it real estate. Last 2 things that I've actually bought for my own personal portfolio are gold miners and land. So that's my most incremental thing. I think investors, based on the setup that we have now, should probably be holding about 20% in cash. I think you're going to get better opportunities through 2026 than when you are right now. And I think the balance should be in bonds. And those bonds should include local currency emerging market debt, which has finally come to life. It was a very good performer in the second half of last year. I think that's going to continue. I think you should own non-U.S. currency bonds as well. But if you don't like the volatility of currencies or feel that it's too risky, you can just buy U.S. bonds that are, I would say, 7 years and in. I'm not a big fan of long-term treasuries. Rosie strongly disagrees with me, but I think there will be a level at which the bond market takes long rates that will lead to a response by the government. It'll probably be, the first response will probably be QE. And if they announce QE of yield curve control, you could get a 20-point rally in the long bond in a week. And so you can't fall asleep. You have to be watching what's going on. I've been of this mindset now for a couple of years, and I have continued to avoid 30-year treasury bonds, and that's been a very good thing. So that's kind of the mix of assets, an unusual mix, but I believe that the macro trend changed in 2020, that the dollar peaked out, bond yields have bottomed, and they will continue to rise until such time as something very radical takes place, like price fixing on the long-term treasuries. So it's gonna be one of these cases. One of the hardest decisions of my career that I actually pulled off almost perfectly was being an all government credit going into 2006, 2007, and then rotating starting March of 2008 and doing it on just constant buying basis. That kind of a pivot is radical. I mean, you go from treasuries to junky mortgages, like really risky stuff. And now I think you have to go from safe things in terms of interest rate duration, and then you're going to have to pivot so that you don't miss out on what could be a big bond rally based upon government intervention. So I think a lot of people are resistant to the idea that something unprecedented can happen, but it does happen all the time. I mean, back in the early 00s, there was a problem with the over leveraging, over indebtedness of auto companies, and the government took the senior secured debt holders of one of the car companies and subordinated them to the pensioners. They're supposed to be the first people paid, and they were pushed back in the bus. Then you remember that there were $2 trillion of mortgage-backed securities, residential mortgage-backed securities, that were issued in the middle of the 00s, around 2006, 2007, and they had clear language in their prospectuses. These mortgages may not be modified under any conditions, but they did it anyway. So things like this happen. The Federal Reserve is not allowed by its own mandate to buy corporate bonds. And they didn't buy very many of them because they didn't have to. All you do is buy a few and say we've got a big bazooka behind this, and that got the market going. So I think that something, I will point out there was a white paper written fourth quarter of 2024 about maybe extending out the debt on foreign bondholders in the Treasury market, dropping their coupon and extending their maturity. Now that was, and then Scott Bessent actually started talking about that as maybe an interesting idea to consider. So if interest rates were to rise, and I'm not predicting this is necessarily going to happen, but if interest rates were to rise, and so that the Treasury debt, which now has an average rate on it of about 4%, a little bit lower than 4%, if that for some reason were to go to 7 or 8%, which sounds high by recent time periods, and if the budget deficit, which is 6% of GDP, goes up to, I don't know, if they expand the defense budget, that would be one way of getting it higher. What if it goes up to, in a recession or a weaker economy, the typical 4 extra percentage points or so, and it goes to 10% of GDP, and interest rates are higher? What's going to happen is you will not be able to fund anything other than the debt expense. It'll go up to something like, the CBO uses ridiculously friendly assumptions, optimistic assumptions. So they show there's problems coming in 2060. Well, I think they're 30 years too far in the future. So I think it's 2030. And under the wrong conditions, we could easily have 70% of all tax receipts going to interest expense, which cannot happen because you got to pay for that $1.5 trillion defense budget on top of it. So this is a really big problem. I think it's absolutely fundamental to fixed income investing. And we've been doing well because we are acknowledging that what the rule book during secularly declining interest rates from the 80s until 2020 is not a good playbook when you're having a different secular trend in at least long-term interest rates. And so a lot of things will work backwards like in the mirror. Like we used to use very, very strong indicator. It was great. The copper gold ratio, the price of the futures on copper divided by gold, was an excellent starting point for where the 10-year Treasury could be. If you took the 10-year Treasury yield movement and you took the copper gold ratio, it was uncanny how they would be the same line, and when they would diverge, they'd come back together again. The copper gold ratio is a total disaster since 2020. I'm actually facetiously saying maybe we should use the gold copper ratio, because it looks like it's being more accurate. These days, actually, both copper and gold are going up, and I think commodities broadly appear to be in the early stages of what could be a significant move. And gold, of course, has been much higher than virtually anybody thought. I was interviewed early in 2025 And there was a moment where gold was at like 2970. And I was asked on a financial program, do you think it'll go to 3,000? And I said, what kind of forecast is that? You're saying it might go up 1%? I said, I believe strongly it's going to go over $4,000 by the end of 2025. But even I didn't think 4,500 was going to happen that fast. But it has a massive breakout. Silver joining the party, and it certainly has. It outperformed gold last year. That's usually a sign that speculators are getting a little bit overheated. But gold has captured the imagination of central banks and now even retail investors. And the only central bank that's really not adding to gold is the Fed. And so if you look at central bank holdings of gold, it's really fascinating. They were at the same level today as back in, I don't know, 1985 or something at the central banks. And then they sold it down, systematically sold gold down at prices of $300 and $400 an ounce. Now they're buying it back, typical, right? Buying it back at 4,000 plus. So not the greatest market timers, but it is interesting that central banks are increasing significantly their purchases of gold, and that's, it's a scarce item. I also think that the nuclear thing, I didn't know they'd come all the way back down. Maybe they're worth buying. Because I think there's going to be a lot of nuclear.
We've got a lot of folks in the administration have close ties, like the Oklo, for instance. Board members of the administration. They're going to back them 1,000,000%.
Yeah,
1,000,000%. So anytime those names dip, and I mean that's just to give you an example. This is a stock is super hot. I don't know, maybe up 300 or 400%. And I got out of it early, but the insiders, the husband and wife, they sold. They socked away so much money. I get really nervous when insiders sell, that,
of course,
right, but they have like Chris Wright and as such friends with so many of these people that everything is going to go in their way the next 3 years, and including demand. But the technology's not really there. Yesterday Oklo was up because they're doing medical radioisotopes. They got a big deal from the government, $2.7 billion. They're giving them everything. So they've got, you have a friendly administration with a big checkbook, sometimes that supersedes fundamentals.
Yeah. Jim?
I'll echo something that Charles was saying about the fourth industrial revolution. And I'd say, Charles, you might not even be bullish enough on it. I mean, I think it is what's happening with AI and what's happening with technology is going to be bigger than the internet itself. I think the problem there is Silicon Valley does a criminally bad job of selling it to everybody. What does AI mean? What do we do with it? It's just a fancy Google search, or it's going to be much more than that. I'll make an attempt to try and make the case for it. And that is that if you look at modern life in 2026, everything is about being digital. Everything is about a computer. And we've made a lot of jobs very soulless because they're all database operators. And I've used the example of go to the airport. All the airport is, I walk into the airport, I can't get through security unless I'm properly in a database, or I go to the counter and they got to fix it. Then I got to get a boarding pass, and I can't get it if I'm not properly in a database. I got to go to the counter to fix it. Then I can't get on the plane unless I'm properly on the database, or I got to go to the counter and they got to fix it. Everybody's a database administrator at the airport. That can be done by AI. AI is going to have to do it. Look, I walk in the airport, they already have facial recognition. Jim's at the airport. Okay, here's his flight. Let him right on the plane. If the database says, why is he at the airport? It better figure it out before I can walk the 8 seconds to security. And don't ask me to go talk to somebody for 20 minutes while they tap on a keyboard endlessly to try and figure out what's going on. That's what we need. That's what AI is going to do. They sell it as it's going to cure cancer. Well, I get it. What they're arguing is, and I'll keep the example very simple, a scientist looks in a microscope for an hour and then spends with a team of people 3 weeks trying to program what they just saw in the microscope to a computer so they can model it. Let AI look at the microscope and model it, and then they can move forward from there and they can make a lot better progress. We are so dependent on computers. They're all too hard to use. All of them are too hard to use in this era because we're so reliant on them. Yes, they're way easier to use than they were 20 years ago, but we're so reliant on them. I don't want to know, I got to go file this, check this compatibility thing. Why can't I just tell my computer, fix it? And it does. And that's what AI is going to wind up doing. So that's why I'm bullish on the idea of AI. And So that'll get me to where I'm at with markets. That is going to be a huge economic driver. It is, and I think it will be. All in, AI, power, the ancillary companies of AI. And I also agree with one other thing that Charles said too. Technology comes in two waves. I've referred to it as the infrastructure wave, which is what we're getting now. We're going to build it. And then the infrastructure wave, like in early 2000, gets overhyped and the infrastructure wave crashes. And that's when the NASDAQ fell 77%. Now channel my inner Jeff Bezos. That was a good bubble. And he thanked all the investors of the world. You gave up your riches and your fortunes, and you left the world with the internet. And then we got people that said, wow, we got this great tool. Let's do something with it. And we got Airbnb, and we got Facebook, and we got Twitter, and we got all of these great, and Amazon evolved into it, and Google became, evolved into it, and we got all these great companies. Well, I think that the AI in the technology wave that we're going to see is going to be something similar. We're getting a big infrastructure wave driven by NVIDIA. It will peak, by the way, in late 99, early 2000. Cisco was a $600 billion company. It was said to be the first $1 trillion company. It never quite made it there. And here we are 25 years later, and it's a $600 billion company. But what we have is many, many technology companies that levered off of all the switches and routers that Cisco made in the internet into what we've got today. So we'll have this infrastructure wave. It will go on for a little while. It will crash. And then we'll leave the world with AI. And then we'll start with some of the names that Charles was talking about. We'll start then saying, okay, what do we do with this? And we're going to start seeing companies come to either use it, whether it's a Caterpillar, or new companies that are going to continue to wave it up. And so I think I'm very bullish on that long term. Now let me turn to my investment thesis. Is a little more short term over the next year or so. Wrote this in an investor letter. We manage an index, and the index is a fixed income discretionary income index, and there's an ETF, WTBN is its ticker symbol, with our partners at Wisdom Tree to track it. And I talked about this in our investor letter we put out earlier this week. If you look at long-term bond yields, going back for the 15 largest countries, long-term being 10-year or 30-year, 15 largest countries, only one of those yields was down in 2025, and that was the 10-year Treasury in the United States. The 30-year Treasury was up. Every other 30-year Treasury, not every country issues a 30-year Treasury, was up in 25. If you look at all of the other countries, all the big countries, the UK was down 9 basis points. I said plus or minus 10 basis points, I'll call it unchanged. There was a couple of them that were unchanged, the rest of them were higher. Every yield was higher in 2025, except the 10-year Treasury. But we all look at the 10-year Treasury and we say, yeah, the market rallied. Well, that was the only one that did. Why? Why did it rally? That's the real good question. Was it that the U.S. experienced weaker growth than the rest of the world? Because that would be what you would associate with falling rates? The answer is no, not really. The OECD, the Economic Cooperation and Development out of Paris, they harmonize economic data so you can compare it across countries. I looked at those same 15 countries, and I looked at what the growth was. The U.S. was in the top third. We were one of the faster growing countries. So our yields weren't falling because of lower growth. How about lower inflation? Rosie mentioned our inflation rates coming down. OECD data, I used core inflation, but on the OECD data, the U.S. is in the 90th percentile of the developed world. That means that we're higher in our inflation rate than 90% of the other countries. Their rates went up. Ours was the only one that fell. Is it that we got our budget deficit under control? I'll sum up that. No, and we could move on from that one. So what was different about the U.S. 10-year relative to everything else to maybe explain why it fell? I can come up with one idea. The President of the United States says, judge me by the 10-year. That's my that's my indicator for success. And the Treasury Secretary, between the issuance changes and the policies they all have been pushing on trying to get that instrument down to say, we are going to be successful. And I would argue it worked in 25, that it fell, even though no other 10-year really fell with it, and no 30-year anywhere in the developed world or the big bond market world went down either. So does that mean, okay, so the 10-year will fall some more because Trump could manipulate it or Bessent can manipulate it even more? Not necessarily, because you can only manipulate it to the point that the market will be tolerant of where you're trying to take it. If you're trying to take it somewhere where it won't belong, then I think you could see it push back. So as I go into 25, I think the economy is going to stay a little bit stronger. I talked about my belief that labor supply is low so that we won't create many jobs, but we don't need to create many jobs, so that I'm not as worried about the labor market as well. And I still think that inflation, even though Rosie, you said, and I remember Powell said that the inflation rate ex tariffs is 2.2%. You know that 2.2% between 2011 and 2020 would have been considered an intolerably high number. We've now so deadened ourselves to what we were running low ones for a whole decade. And now we say 2.5%, mission accomplished. It's no different than the low ones. No, it isn't. It's a very different number. And also we have a very high inflation rate. So I see that rates will start to drift higher. And I want to emphasize that word drift. I don't think they're going to blow up or crash or anything else like that. And so I'm positioned that way with shorter duration than a benchmark index, that they're going to go higher. The yield curve will steepen out, because I agree that while the Fed wants to cut rates, maybe will cut rates, at best they'll hold. So short-term rates won't be drifting up as well too. On the dollar, I have a little bit different view on the dollar. I'm kind of the inverse of you, Danielle. I think it's going to be strong in the first half and weak in the second half. The reason I say that is that I'm looking at the dollar index. It bottomed in September, and Jeff, you're right. The relationship between dollar and interest rates completely exploded in 25. It used to be, tell me where interest rates are, and I can tell you where the dollar index went, and that's no longer the case right now. But I do think that the dollar has at least found a low in September, and it might start to continue to recover. Let's call it a retracement rally, because it's not going to get anywhere near its highs of late 24, and then maybe roll over later in the year. So at least for the short-term part of the year, I think the dollar is going to continue to go higher. I also like very short-term 0 to 5 year tip securities as well too, on this whole idea that we're going to see a little bit more strength than we've seen in the past. Now, yeah, there's pitfalls and there's concerns that I have. The biggest one I have is what you were talking about, Rosie, is the unemployment rate. That is one that does really bother me, that I can see the case that it will continue to go higher. I can see the case that could empower the Fed to feel a more sense of urgency to cut rates. If they're wrong and misjudge that with the unemployment rate, kind of like they did in 24, they cut 50, 25, and 25 on the idea that the labor market was falling apart because the SOM rule got triggered and a bunch of other, and it never happened. And then we saw a bad reaction out of the bond market in late 24 and into 25 when we pushed the 10-year yield up to 490 right before Trump's inauguration. We could see something similar to that. So if they're going to cut rates on the higher unemployment rate, they better be right that it is a signal that the entire economy is coming down, or they're going to repeat late 24 and 25. They'll cut, and the bond market will completely reject it and move higher. So short duration, I'm bulleted, think the curve is going to steepen. I think the dollar's at least found an interim low for the next several months. I like short-term tips as well too.
We've created a sort of comic relief chart, but it's also sort of uncanny. And that is, you take the dollar, the euro, and you map it starting election day, the first 2016 and 2024, and it's uncanny. They're exactly the same. And not that means it's going to continue to be exactly the same, but that chart would suggest, if that holds up, that the dollar is going down in the weeks ahead.
Interesting. The last thing I'll say,
there's no reason that has to be right.
You're right.
There's no cause and effect.
One of the other things that I would say from a contrarian standpoint is, when the dollar was falling through the summer, we were talking about the loss of American exceptionalism. Where did that phrase come from? That came from Tocqueville's book about 200 years ago about American being exceptional. Now, 200 years ago, the word meant different. The word meant unique. today the word exceptionalism is thought of as being kind of a condescending term. We are better, we are superior to you. That's not exactly the term, what the term meant. So I always used to look at when people said that, is the dollar falling the loss of American exceptionalism? That's just a bunch of upset Europeans trying to take a shot at the U.S. And that's why I thought, we kind of overdid this talk. Yeah, the dollar could go down, but you don't have to say that the country is going to hell because the dollar's lost a few percent. I know you'd like to put us in our place because the European economies have been struggling so long. And that's why I think that the dollar's going to, at least stay here and maybe rally for a little bit. But I want to emphasize, I'm talking about a retracement rally, not something big. And we'll see what happens in the second half of the year.
Dave, the floor is yours.
I probably am more aligned with Jeffrey Gundlach than anybody else on the panel. And it's not just because he invites me back to this event. So I think, look, the reality is that we get sucked into the vortex of the calendar year, which is just a historical quirk. But we'll talk about 2026 then, and what I'm doing. So I think that I want to take my lead from two people that are a lot smarter than I am, and probably much better track records, which is Warren Buffett. And I think that we should ask ourselves a question as to why he goes into 2026 with almost a $400 billion cash reserve, and 30% of his AUM is in cash for the first time. Yeah, he's retired. So this is his farewell gift.
I mean, it's always good to have $400 billion in retirement.
So when I said Warren Buffett, let's say Berkshire Hathaway.
Okay.
So I think we want to contemplate that. And then what I found was interesting was after the Fed had announced, for whatever reason, it could be technical or liquidity reasons, that it was going to re-engage in expanding its balance sheet. And Jamie Dimon right away said that whatever proceeds JP Morgan gets is going to be deployed into the Treasury market. So I found those two things very interesting, and it comes down to, I guess, how DoubleLine is positioned between being more constructive on treasuries and having a cash position, which I think 20% is actually very appropriate. I don't know which part of the curve I prefer the most. I probably would just have a laddered approach to the Treasury market because I do have a more aggressively dovish view on the Fed than Jim Bianco does. And as Gundlach said, the 2-year note follows the Fed. The 2-year note now has the Fed's forecast. I don't. So I like the 2-year note a lot. The 10-year, well, what I'll share with the group is that very recently I had Ivy Zellman on my webcast, and she's basically America's housing guru. Now, she wouldn't go into specifics, but she did say, she let something out of the bag because she's been spending time in Washington, that the White House is cooking up something in their affordability package, which is forthcoming, that's going to deal with housing. So I don't know what that means for the 10-year note, but it doesn't leave me bearish, that's for sure. And then there's the long bond, which has been a little orphan Annie, which we've talked about. But I got to say, the long bond yield close to 5%, that's just very tempting. The real yield at 2.6, that's really tempting for me. So I would say, actually, I like the whole curve. And the other bond market globally that I like a lot, for similar reasons, is the gilts market, the UK gilts market, because I think the economy there is going to weaken. Inflation is already coming down after the scare they had and will come down further. And the BOE, there's not enough rate cuts priced into the gilts curve. So I like UK gilts as well, and I'm happy to take the exposure in sterling since I'm agnostic basically on the US dollar. So that's fine. In terms of the equity market, we have a large exposure in our model portfolio in Asia. I'll tip my hat to the fact the U.S. stock market had another great third year in a row, but the rest of the world, even including Canada and Mexico, who were tarred and feathered by the tariff threat and the actual tariff action, Canada and Mexico outperformed the S&P 500 last year. Go figure. Who thought that was going to happen last April? But Asia was the big winner. And within Asia, I will say specifically the one country that is sticking out that lagged the regional benchmark last year is India. And I wrote a report on it. And we just may carve out and just go long the Sensex for this year. We actually love the Indian stock market. In terms of sectors, well, a lot of things that were mentioned, I still like. I like the miners. I like the gold miners. We're still there. We actually like Canadian pipelines a lot. And that is basically growth with yield. We like the global airspace defense. That is probably the best hedge, maybe better than gold even in terms of what's happening around the world. And the military budgets are expanding everywhere, not just in the United States. So that's an area that has tremendous visibility. And energy infrastructure. So we like the refineries, and we like the oil services. And these are positions we added on recently in our portfolio. So you can almost say that this is almost like a hard asset cash flow derivation type of, I would say, low beta, high Sharpe ratio, good running yield type of a portfolio. In terms of just one comment on gold, and I agree with copper, by the way, because look, if we're looking at supply, it's got a very powerfully inelastic supply curve. Copper is as much of a no-brainer in a secular bull market. Gold, and I agree with silver. Silver, I mean, the gold chart never looks like silver. It never goes asymptotically north. But gold is in a bona fide bull market. But it's been in a bull market since 1999. People don't realize people just caught on to it the past couple of years, or maybe the past year. Or maybe they caught on to it, after the Russian dollar reserve assets got frozen. But gold has been in the secular bull market for 25 years. And back to what Jeff Gundlach was saying earlier, you can't look at this bull market in gold without looking at the secular bear market that preceded it, because from 1980 to 1999, the gold price went down like 50%. And the only reason was because the global central banks were converting their gold reserves into treasury bills. And that went on for 2 decades. And at the peak in 1980, global gold was 70% of global FX reserves. And at the low in 1999, it was down to 10%. I mean, the Bank of England cut its gold reserves by half. Canada, which is the world's 4th largest gold producer, the Bank of Canada had no gold in its reserves whatsoever. So in 1999, it got down to 10%, but that marked the low in the gold price at $255 an ounce. It was the Washington Agreement at the end of 1999 when the global central banks agreed not to sell any more gold, that gold started to go into its bull market. And as Jeff Gundlach had mentioned, what's the share now? Well, it's about 25% of gold is in the vaults of the world central banks. We're nowhere near the former high at 70%, and I doubt we'll get there. But if you believe in Bob Farrell's rule number 1 on mean reversion, and if the mean is more like 35 to 40%, and you look at the fund flows, because the primary source of demand, the thing about gold is that 85% of all the gold is already above ground. And it's getting more and more expensive to bring any new gold above ground. So the gold supply curve is running about 1% annually. The key is not the supply, the key is the demand. And the demand is running 2.5%. And it's not because people are running off to Costco to buy all those little mini bars. And it's not the dowry season in India. It's the central banks. It's the central banks that are driving the fact that you have 2.5% global demand and 1% global supply in something so valuable and malleable and beautiful as gold. So until those curves sort of shift, the gold price is just going to continue to move higher over time. And if we actually mean revert and you look at the fund flow and backdrop that against the stable supply curve, gold is going to break above $6,000 an ounce. So that is, again, a strong conviction call, is the gold and the gold mining stocks. And that's still a core part of our portfolio.
All right. I'll give everybody one last shot. Do you want to add anything? Take anything away?
Internationally, from the stock market point of view, you like Latin America, Mercado Libre, MELI. I don't know why it's come down as much as it has, but I think it's going to be a grand slam. In Africa, Jumia, JMIA. That's a stock maybe you want in your portfolio for the next 3 or 4 years.
That will wrap up the 2026 version of DoubleLine's Roundtable Prime. We thank you for participating with us today. Thank you for joining us, and thank you most importantly to all our panelists. We obviously couldn't do it without you. Thank you for making the time out of your day, coming out and seeing us, and sharing your insight with our clients. So let's give them all a round of applause.